This last video is about the results in our financial model. You might notice that we have three parts of our financial basic model, which the first one is parameters, then the process, which we make some videos on it, and last our results. Notice that in the process we project the income statement and the balance sheet according to the information in the parameters, the data in the parameters. But now we need to make some ratios or indicators so we can make decisions. So our first one could be the break-even quantity. By that I mean how many units I need to sell. So here in the operating profits I make no profit at all, so zero here. In order to do that, we could try to lower the quantity till we get the result, but that would be maybe too difficult and will take a long time, so we might want to use an Excel tool. So we stay here on the cell C39, which is the first year operating profit, and then we go into the menu, datum, then we go to what if, and then goal seek. Right? In goal seek we select, we already have this cell selected, we could do it again, which is the defined cell. It's actually, there is a formula in there, so that is one of the parameters in order to perform goal seek. So basically goal seek is, it will try different values so we can get zero right here on C39, which is our operating profit. And the changes that Excel will perform are actually in changing the cell quantity, which we defined right at the beginning. So now we hit enter, and then appears that whenever we sell this amount, 5,000, I copy it, and I will paste it down here, operating. So whenever let's round it up to 5 here. Whenever I sell this annually, I will go break even on the first year. So that data is on the first year, and the net is it will be different, because the net break even point, it will be using here the net profit with a zero value. So again, what if goal seek the value 0, changing the quantity, which is on top. So hit enter and go. So it's a little bit more. So whenever we sell 6,367 on the first year, we make no profit. We won't make net profit. So I should paste it here. Let's round it up to 7. So this will be my goal on the first year. I need to sell at least 6,367 t-shirts under the conditions selected on top, in order to go break even, which is making no loss, no profit. Then there is to estimate the profitability indicators, and the first one, it will be the operating margin, which is equal to my operating profit divided by my total revenue. Here it will be quite low. It's actually a percentage, but remember that this is not my base original data. I need to go back and type 10,000 units sold on the first year, which is my goal. Then margin, it will be equal to my net profit divided by the revenue. So it's net profit divided by revenue. All these margins are against the revenue. So again, a percentage. And the return over investment is it will be equal to my net profit that I get every year divided by my investment in total liabilities and equities. I have no short-term liability because all my loan is a long-term loan, and my capital is also long-term. So it would be equal if I take liabilities and equities or total assets. But I need to fix them because they will stay the same. So all this data is should be estimated over the 5 years. So it's only a matter of dragging it to the right, and you notice that it increases over time. There is also another important profitability ratio, which is the return over equity over the investment in capital here, in capital stock. And the same is the net profit divided by but only the capital stock, and I fix it because it will stay the same for the whole time. So it's actually quite high, 76%, and I drag it to the right. So it should be the greater because it's the smaller number there at the determinant. Then, there is another type of ratio, which is our gross cash flow, and that would be equal to our net profit from operations, right here, our operating profit that we have here right before the interest expense. Sometimes it's estimated right after interest expense, but for our purpose here, we should consider the operating profit, and some other estimations subtract the taxes that the company should pay. But for our basic model, we only want to consider how much money is this company generating in terms of profits, operating profit, and plus our depreciation. Remember that we should add or increase this depreciation in our gross cash flow because this money is not paid to anyone else. This money should stay within the company. So it's actually a quite high amount of money. And the payback period, as a last of our indicators, is the time we need to return our investment in terms of profitability. So remember that here we are investing 140 million pesos in total as a total investment, adding liabilities and capital stock. On the first year we make a bit more than 50, then a bit more than 60, and then a bit more than 70 million pesos. So if we add this number, we notice that we made back the money before 3 years because we're investing 140, and then 3 years is equal to 192 millions. So it's only a matter of typing the 3 because 3 years is what we estimated there. If we try to divide them, we get different results because it depends on the increase of sales, and well, there are different values that makes the number sometimes not readable, right? So in 3 years we made back the money invested in the company. That would be it for our first series of videos on our financial feasibility based model. Thank you for watching.